Okay, guys. Again, welcome. This is the first part of the course. Now, before we delve into the indices and also the sites where we can see the indices and also trading the indices, what I want to go through is really general concepts about trading. These are covered in Fundamentals Trading 1 and Fundamentals Trading 2. And what I want to do by this is basically to get you used to the real facts of life about trading. Okay, that it's not as simple as you think. It's not what like the internet shows you. It's actually quite a serious undertaking. You have to run it like a business, and just like a business, no profits are guaranteed. There are profits and there are losses. So if you want to be a good trader, you really have to get used to losing and control the losses so that you can come back whenever the market is going back up again and it's in your favor. Now, I see a lot of traders, they lose all their trading capital. Okay, we say to them that they blow up their accounts before they even have a chance of making it well in the market. So you really have to put in capital preservation as your number one goal. And in this presentation, I'll show you why that most traders are going to lose money. Most traders will continue to lose money despite all the advances that we have made in the internet, all the trading platforms and stuff, because it's really about psychology. Okay, that is what eventually is going to determine success and failure. Okay, now trading is about psychology. Now, there are two parts of trading. The first one is qualitative. These are trading plans, entry, exit patterns, your various indicators, MACD, all that. Okay, so we know that trading is all about psychology, at least most of it. Well, if you didn't know it, then you know it now. Now, the two parts of trading, which is quantitative and also qualitative. Now, in the quantitative part, you have all your trading plans, the entry and exit patterns, indicators, the MACD, the slow stochastic, your Fibonacci, and all that. Stop losses, your target profit, trailing stops, how you follow trend, risk management or money management, how you control your losses by trading, whether you're trading the big lots or the small lots, the various candlestick patterns. Now, the reality is for all these quantitative aspects of trading, you can find it in many books on the internet, you can find it on YouTube, you can even find it in the bookstore. But, you know, if you have to ask yourself, if there's so many of these, why do people keep losing money in trading? It's simple because it doesn't depend on the quantitative. Okay, it all depends on the qualitative, and that is where you have psychology, and really this is in combination with real money management. You got to know how to manage your money in order to minimize your losses so that you survive when the market does come back. So by combining psychology and real money management, this is how you build a platform so that you are able to trade profitably over a long time. So, the number one rule in trading that I apply, it's very simple. When losses get too high, if it's too painful, then cut it off. Go and extract your teeth, okay? That's it. It's gone. You can, as long as you preserve your capital to live another day, I guarantee you there will be another opportunity that you can take off in the future. So this is about the art of losing money. So this is actually a probability table. You see what they did was they took basically 10 to 15 of the best traders for hedge funds, and they drew out the probability of losing money. What is the streak? So although these fund managers were making around 20 to 25%, let me tell you that if you look at their trades day to day, there were times when they were losing, when they were consecutive losing trades, and we have to take care of that. So they plotted all this out in a very nice table, and this is what they got. So fact is, if you have a win percentage of 30%, you're going to have a probable losing streak of 30. That means you're going to have one day, you're going to be subject to a very bad period where you have 30 consecutive losses. If your win percentage goes up to 35%, it goes to 25, and so on and so forth. Now, look, even if you're at 50%, which is damn good, okay? That means one of our two trades are already right. Your probable losing streak is still going to be 16. You go up to 60, it's going to be 12, 70% 9, 80% 7, and finally, even at 90%, man, you're one of the best traders ever. You're still going to have a 5 losing streak trade, okay? So you don't have to take it personally. It's really all in the mathematics. This is part of life. So the thing is this: you will have a losing streak one day. You need to ask whether your trading system prevents you from blowout. Now, this is how it works. A lot of people teach you that you can risk 10% or maybe even 5% of your trading capital on each trade. Look, even if you have a 90% winning streak, 90% winning rate, once you come to the five consecutive losing streak, if you're risking 10%, your account is going to be halved. Okay, it's going to go down by 50%, and you're going to get much worse. Look, even if you have 60% winning percentage, if you're risking 10% of the trade, look what happens. You're going to blow out your account because you're going to have a consecutive losing streak of 12. Next, what if you risk 1%? Now that's different, okay? If you have a win rate of 90%, you're still down by 5%. If you have a win rate of 60%, you're down by 12%. 88% of the capital still intact. Hey, you can still survive. And even if you're one of the worst traders in the world at a win rate of 30%, as long as you risk 1%, guess what? You're going to end up losing 30% of your capital. You can recover from 70% back to break even. It's going to take some time, but you can do it. At least you don't blow out your account. However, if you take a risk, like some people say that you got to take a risk of 3%, then you're going to blow out your account very fast because look, you're a newbie, okay? You're going to come to a 30 consecutive losing streak, and 30 times 3% is 90%. That's equivalent to a blowout of an account. So don't ever take too much risk. Try to limit it to 0.5 to 1%. You'll be okay. Once you're more experienced, you can probably change it to 1.5%. So this is very important for you to survive in the longer term. Now, there is something that's called a point of no return. Now, I talked to you a lot about losing money just now, but that's more on the mathematical side. There's also a psychological side where a trader, if he loses a certain amount of money, simply goes to the point of no return. And this is usually defined as, once you lose 20% of your account equity, you've reached the point of no return where you can't really come back. And why? Because this is a point where you're really down. You're going to hesitate to pull a trigger. Uh, this is where you're so scared. You're so scared that going back and trading will result in you blowing the account. Unfortunately, people don't focus on this, which is why they are in the beginner cycle forever. So, although I put a lot of numbers down there, basically, if you're down to 20-25% of your account and you still trade, you are entering a new, different psychological state. You'll probably lose the account anyway. So what we need to do is really get the process right. Okay, don't worry about the money. Don't overestimate trading. Just get the process right and trade well. You don't necessarily need to make money, but you need to know how to trade well in order to preserve your capital. Now let's go back. Assuming that 20% is the point of no return, I mean, you could be someone having 50% probability. Look, if you have 16 consecutive losing trades and you're risking 1.5%, you're going to have a 24% drawdown or 24% losses in your account. That, my friend, is enough to damage your account. So think about this carefully, okay? Now, another statistical tool that people use is a lot on this risk reward ratio. Is if you have a certain historical win rate, how much do you need to risk compared to your reward to go in? So this is another table that was done by a study on real traders. So it says that if you have a historical win rate of 25%, basically to be profitable, you need a risk reward ratio of 3 to 1. If you're at 33%, you need it 2 to 1. As your trade percentage goes up at 50%, you need it 1 to 1, 60% 0.7 to 1, 75% 0.3 to 1. Now, you might think it weird that you have a reward to risk ratio of 0.7 to 1. Why would I be making 0.7 in order to Okay, another tool that we use a lot is on the risk reward ratio, or let's say reward to risk ratio is what amount are you going to risk relative to the reward that you're going to get, and this is also correlated to the percentage of wins that you have. So if you have a historical win rate of 25%, you need to win 3 times, okay, and have one loss in order basically to be sustainable over the long run. Or rather, you need to take a risk of 1 in order to make a reward of 3. This is simple mathematics. You could be risking 30 pips in order to make 90 pips. That's how it works. Or risking 10 points to make 30 points if we're trading the index. Now, if your historical win rate is 33, you need a reward to risk ratio of 2 to 1. If it's 50%, it goes to 1 to 1. That means basically if I'm planning to make 50 points on the index, I could be risking a 50-point loss there. Now, as you go higher, 60 to 75%, guess what happens? The reward to risk ratio can actually go down 0.7 to 1 and 0.3 to 1. Basically, at the 75% level, if I'm right, 75% of the time, I could be risking 100 points in order to make 30 points. Now, you might say, hey, that's so illogical. Who would want to do that? Well, let me tell you that there was a study by FXCM that says that the best reward to risk ratio is actually 1 to 1. And if you go down, you have a better chance of making money. You know why? Because you can pull the trigger, you can take the profit very fast and get out of the market, and thus not be subjected to risk. So the challenging equation here is how do you move down so that you have a high historical win rate and a lower reward to risk ratio in order to do it. Now, the other way to do it is just throw this table away. You need actually a higher reward to risk ratio, okay? Like in the video that you're going to see in the next module, the billionaires, actually people like Paul Tudor Jones, he will risk 5 times, 10 times rewards for an amount of risk. So here the risk is very, very low compared to the reward, and that's how these super investors can survive for the long term, because they risk very little relative to the reward, and when they lose, guess what? They can lose only what, 0.5 to 1% of their account. Of course, they'll survive for the long term. Of course, they're going to end up making very good returns. So stop loss is another example, because my stop loss is based on psychology. It's basically based on the pain threshold. When do I feel pain? Nothing more, nothing less. If I don't feel pain, then I don't need to set the stop loss there. If I feel pain, I do. So, it could be the first level is basically 0.5 of an account. So if I have a US 20K account, I could set the stop loss as $100. If I had level 2, if I'm more confident, I should only risk 1% of the account, which is $200 for a 20,000 US account. Now, this is very important because indices are very wild and volatile, and this is why I set the stop losses at this level, because in a DAX trade, I know I can make $100 when it goes my way easily. So, if I'm losing $100, I need one trade to basically make back the 100, and probably I need another trade to basically be profitable. Or if I'm risking 200, then it's okay. If I'm risking 200 of stop losses, I can easily make back the 200 in 2 trades of the DAX. Now, that's how I do it for mine. Again, my stop losses are based on psychology, but just to give you a warning, yes, there are very, very real stop losses here. Please don't fool around with this. If you're scared that your stop losses are eating you too much, then just minimize it, okay? Never go without a stop loss, I tell, especially for young traders. So here I even show you an example of me getting totally burned because of psychology. Now, this is an example where I got burned for $148 in a trade for the USD JPY, USD yen. Usually I'd put an amount there, not 600 in my margin. It's usually 300. But again, because I was so busy, because I was panicking, because I wasn't focusing, I was upset, I ended up making this mistake, and I ended up doing something really stupid. So the lesson here is if you're not in the right state of mind, I don't think you should trade. Don't be it like me. Again, you just cause serious damage to your account. You don't want to do this. So the way I teach is this: the traders tool. I think the key is copying and learning. So I think what we need to do, the way I teach traders, is simple. We need to learn to copy through the best traders out there, whether they're on eToro. I subscribe to a service called Profit Pips here in Malaysia and Singapore, and also read a lot of trading floor from Saxo Bank. We'll go through all this, okay, in another module. Another way to copy is actually learn to copy through robots EA. Now this I kind of like because robots are on all the time. They're very good at taking entries. Now they may not be very good at exiting, but of course when a robot takes entry, you have the choice, okay, you have the choice to actually make a decision to come out.